Arrowhead and Zurich have teamed up to offer multi-line package coverages at competitive prices. We're bringing new life to ambulance insurance. Learn more at arrowheadgrp.com/ambulance.
Carrier Management Suzanne Sclafane caught up with Dowling and Partners VJ Dowling and A.M. Best Matt Mosher at the PC Industry Joint Insurance Forum in New York, where questions about prospects for profitability, growth, loss reserves, and M&A activity in 2013 were on the minds of executives in attendance. Here, Dowling and Mosher share their views.
I think growth will be better, in part because the growth that I think people are talking about is on an earned basis, earned premium, and we're now at a point where we've already been through a full cycle of rate on rate, if you will, and while the rate increases are starting to earn their way all the way through into the income statement. So I think, yes, we'll be higher on rate. With respect to the reported combined ratio, which I think when people are talking about that, they're talking about a calendar year combined ratio. The calendar year combined ratio probably will improve, but not as much as one might suggest based on what you're hearing about rates, because of the issue of, we believe, a smaller positive benefit from loss reserves.
Even without Sandy, we've seen rates move at a level, somewhat better than where they were last year, and loss trends haven't been moving quite as badly. So I would say at worst we would expect profitability to kind of stay where it's at. Given investment yields, though, that's on the underwriting side. Given investment yields and the pressure that companies have with the new money yield, that's going to continue to put pressure on earnings and what their expectations are and their ability to meet the levels that investors or constituents might be looking for.
Mosher says A.M. Best expects the magnitude of premium growth to be somewhere in the low single digits, but neither analyst believes growth through M&A will be big headline news in 2013.
I really think it'll still be limited. I think you look at companies, as we mentioned the reserve issues and what's out there. Any buyer is going to have to be very concerned about where reserves are for a company that they're looking at. What we may expect to see as companies look to find growth through M&A is more book business and book acquisition type of purchases. The other issue when you're trying to buy a company is the whole meeting expectations. You have a seller with certain expectations. Typically, most of these companies are trading below book value. They don't want to sell below book value, and you have a buyer that looks at it and says, well, I'm not going to pay you more than that. So getting those expectations together make it very difficult. I would expect that the M&A activity will pick up a little bit more when you start to see some of these companies feel some of the pressure of loss reserves, earnings type pressures that they have, and they recognize that they aren't competitive in the marketplace.
And I would probably tell you this every year, that we're not going to see a lot of consolidation. The investment banks love to talk about it because that's how they get paid. But we also have something that we would refer to, which is the Allegheny doctrine, which is that if you are an insurance company and you do not want to be taken over, as Allegheny learned when they tried to buy St. Paul in the mid-1980s, and the great state of North Dakota was able to kill the deal. You don't have hostiles here. So if you do not want to be taken over, you won't be. And you have social issues that managements all think they're a survivor. The boards all like being on the board and getting well paid. And so there is not an incentive for the type of consolidation that arguably should happen. And when we look at it, it only happens if there's a management team that has no successor and raises their hand and says, we want to be bought. It happens because a company is either owned by private equity or has a very substantial single shareholder, or somebody has the ability to make a cash bid which is substantial, which nobody does in today's environment, or lastly, the shotgun marriage, where the rating agencies come in and say, you have trouble. If you don't do something, we're going to downgrade you, and you get a consolidation as a result of that.
The low interest rate environment was a hot topic among executives at the forum. Here, Mosher explains how PC insurers are dealing with it, and if analysts are concerned with the investment strategies they're seeing play out.
I wouldn't necessarily say we have major concerns. We are seeing companies reach a little bit more for yield, and whether it be duration or different types of assets. But generally, on a controlled basis, what it's really done is kind of kept the overall yield at the level from year to year, is what we're seeing. But it is a pressure that they're dealing with. What I see is more of it's a pressure on their underwriting side and the need to look at underwriting long term. If interest rates stay at the level that they're talking about for 2-3 years, you have to plan that. That's got to be part of your overall underwriting pricing levels and what you're looking for. And you continue to increase risk on the asset side, and we've seen that through some of the financial crisis, where companies took on an enormous amount of risk on the asset side of the balance sheet that had a major impact. So most insurance companies look at it as, I'm an insurance company. Underwriting's where I make my money. That's what I'm looking for. So they try not to take too much risk, and I don't think we expect to see much reach in terms of the yield.
We have not seen a lot as far as companies lengthening their duration. We clearly have seen companies starting to allocate more assets away from lower risk fixed income securities to high yield securities, to bank loans, even common stocks, which are higher yielding. So yes, there has been a movement, and continues to be, into riskier assets. And from our perspective, we're not sure that's the right move, because if you look at the spreads over risk-free kind of returns, they're at pretty close to historic lows. So you're not being paid on a relative basis, but companies are looking at absolute. If I can get 6% in a junk bond portfolio, that looks interesting relative to 2% in 10-year treasuries.
With respect to loss reserves, Dowling says insurers are still in the cheating phase, a phase in which reported calendar year results are better than underlying ultimate accident year results.
And that comes about by comparing the loss ratio pick that people are putting up for the current business relative to what's happening with prior period loss reserves. And our belief is we're taking through the income statement more loss reserves from old years than we are putting in to the balance sheet. If you think about it, we're taking more cookies out of the cookie jar than we're putting back in. And in that environment, the balance sheet is being weakened. The results still are legitimate, but the balance sheet is being weakened, and that can't go on forever.
At this point, we're still looking at another 2 to 3 years of reserve redundancies before there really are some real charges that are going to probably have an impact that might drive the market to firm to the level that companies are more profitable.
As carriers continue to take down loss reserves for prior years, Mosher explains what trends he sees in recent accident year loss picks that carriers are making.
I think they are being fairly conservative, but there's still, I think there's always that tendency to be a little bit more optimistic than might be warranted if you really looked at things. But what we've seen in the industry, and we see it from cycle to cycle, you see an improved discipline across the board. And that's another reason why you see the cycle playing out longer is that companies have been fairly disciplined. It's just a matter of that human nature of being a little bit more optimistic than would be necessarily warranted given the pricing levels that are available in the marketplace.